Mamelo, thanks very much indeed for talking to us. So this was largely expected, but I'm just wondering, it's quite interesting to see that the governor and the Reserve Bank not seeing inflation doing anything to on the upside. So inflation well contained, at least for the medium term. That's the biggest factor when deciding on interest rates.
I think, if one takes a step back and just look at how much the Reserve Bank has sort of acted since the beginning of this year, they've cut interest rates by around 300 basis points, and this is on the back of lower inflation and, as the governor highlighted, very weak demand. So this very weak demand is expected to continue to keep prices contained. The governor highlighted that they are aware that there are some potential downside risks to the inflation outlook. He highlighted medical aid insurance, for example, and he views the risk to near-term inflation to be relatively balanced. And that's the view that we also hold. But we do think, as these risks move either to the upside or to the downside, the central bank will likely act based on that. He did highlight that they are quite data dependent at this point.
So just in terms of expectation for consumers, I mean, even at the last MPC, it was understood in many ways that the Reserve Bank will not be aggressively cutting interest rates anymore. Based on this particular speech, he says the next move, perhaps in the third and fourth quarter of next year, would actually be 2 interest rate hikes. So consumers have to prepare for that the next time this interest rate moves, it most likely would be a hike.
I lost you there for a second, but just to be sure that I understood your question, are you asking around the expectations of higher interest rates in the third and fourth quarter of next year?
Yes, indeed. I mean, the next move consumers could expect is not a cut, Mamelo. What we get from this is that it will actually be a hike.
Definitely, I think. Definitely, sorry, I keep losing you there, so I hope I'm not speaking over you, but that is correct. So we're definitely of the view that we're probably close to the end of the cutting cycle, and our expectations are that the next move would be slightly higher. Our expectations, however, are not for interest rates to move high as quickly as the QPM are forecast, which is towards the end of next year. And this is because we think that inflation should remain fairly low, supporting, I think, fairly accommodative monetary policy. But however, we are monitoring any risks that I think question this view. One would be the currency. If the currency weakens quite significantly, of course, it poses upside risk to the inflation outlook. I think also the growth outlook is quite critical. The governor highlighted that, in the developed markets, there's some economies that are going through lockdowns again, and we're not quite sure what the impact of this is going to be on global growth. We're also not too sure if South Africa may experience something similar, which ultimately will have some impact on economic growth. So I think that the data that we get from the fourth quarter moving into the first and second quarter of next year would be quite critical in terms of what the recovery looks like and what prices in the economy look like. We hold the view that prices should remain relatively contained because of fairly weak demand in the economy, and as a result, we expect lower for longer interest rates. We expect flat interest rates for quite some time, but just like the South, we're also monitoring these developments to gauge whether the cycle is turning.
Mamelo, if the equipment doesn't fail us here, just a quick final one to you. Again, we hear the Reserve Bank governor reminding us, and he's done this several times, that the Reserve Bank is not the heart of the solution to South Africa's economic problems. He says structural changes in the economy needs to come from the policymakers, and I suppose suggesting that consumers should not run to the Reserve Bank for relief. We've got to take care of this economy on a structural level.
That is correct. Again, just to go back to what the Reserve Bank has done to date from an interest rate point of view, I mean, they've cut interest rates quite aggressively, more than our comparative peers. But the problem, even before the crisis, has always been structural issues within the economy. And I think the need to implement some of these reforms that have been highlighted in the President's recovery plan is quite critical to address the the issues that we're seeing in terms of very weak employment in the economy. The President spoke about an infrastructure drive, which he says is a flywheel for economic recovery. So really, it has become quite critical for us to see some of those plans being implemented. The Minister of Finance as well highlighted in the MTBPS that for us to see long-term potential growth, it is quite important that we urgently implement these reforms that are going to get economic activity going. Monetary policy alone cannot fix the issues that we are experiencing in South Africa. Policy needs to come to the fore, and more importantly, we need to implement some of these recommendations that have been put forward.
All right. Thanks very much indeed, Chief Economist at FNB, Mamelo Matikinga.